So I don't have anyone on physical class. So online, I'm relying purely on your answers. So you will keep me there. So open that question. So I hope everyone is there. I hope everyone is there. Yes, so I read it. It says, the following draft consolidated financial statements were extracted from the financial records of G Group for the year ended 30th September 2022. So consolidated statement of profit or loss, as you can see. Also, we have consolidated statement of financial position. Also, you can see it there. Perfect. Additional information number one, the property, plant, and equipment comprised the following. So their cost, provision for depreciation, carrying amounts, as you can see there. During the year, G Limited disposed of an item of equipment for cash proceeds of 260. The equipment had cost 750 million and had accumulated depreciation of, I believe that is 370, it's not very clear. Any gain or loss on disposal and depreciation on property, plant, and equipment is included in the cost of sales. On 1st of January 2022, G Limited acquired 75% of the 100% ordinary shares of shillings 10 each in Salama Limited. The acquisition consideration comprised a share exchange on the basis of 2 shares in G Limited for every 3 acquired shares in S. G Limited was also to pay shillings 810 million to the owners of S Limited on 1st January 2023. G Limited cost of capital is 8%. The market value of ordinary shares at 1st January 2022 was shillings 30 and 20 for G and S respectively. The fair values of assets and liabilities of S Limited at the date of acquisition were as follows. So property, plant, and equipment 5, provision for depreciation 29, inventory, trade receivable, current tax refundable, deferred tax asset, trade payables. So this question is good because it is on acquisition of subsidiaries. Remember, the question we did was on disposal. So this one is on acquisition. But there will be nothing big. You see, disposal, we were subtracting. Acquisition, now we add. So where you were subtracting, this time now you just add. So there is no big difference. The group's policy is to measure non-controlling interest in subsidiaries at fair value at acquisition dates. The market value of the subsidiary ordinary shares are considered to be representative of their values of shares held by the non-controlling interest. Investment at fair value through profit or loss consists of highly marketable risk-free securities by G Limited. Any impairment loss of goodwill is included in the administrative expenses. Required consolidated statement of cash flow for G Group for the year ended 30th September 2022 using the indirect method in line with IS number 7, 20 marks. So maybe I would want to do some, like how many? For there, I can like maybe to do like 2-3 workings, then we can kick off. But before that, there is somebody in the morning who had asked, how do you present workings when it comes to exam? Before I could even answer, the power went off. So in exam, I have a sample book here, just for illustration purposes. So in exam, if for example, this is your book, assuming this is the booklet, sorry, this is the booklet, what happens, like in this question, it is cash flow. Cash flow is likely to take a full page for presentation. So the first page of the booklet is for presentation. Then workings, your working should be on this page. Your working should start here. So working. When you are done, the other question, let's say maybe it is group. This is presentation of P&L. You leave this presentation for balance sheet. Working starts here. However, there are some people who prefer doing this in exam. They make a good line in the same page here, a margin here, so that the working was on this side or in the same page. Then presentation is on this side. That is still okay, provided you don't include workings and presentation in the same. So you can separate, I don't know, for lack of proper word, you can make a line in the book, the right margin for working, then here for presentation. That is still okay. If your handwriting is quite big, you can just leave a whole page for presentation, then working to the other side. But I fear you might use so many pages. Ukitumianga mingi inachokeshanga marker, so you can just compress them in one. Workings, because workings nobody will mark. So workings candle, then but you must separate with a ruler. Evil. So the one of that question, I hope you are here and you have understood what I was saying. So now I will want us to kuna mtu amejoin class na jina J. Hey, okay, sawa. Let's proceed. So I want us to do some small workings. Also, nimeona they have not given us the value of depreciation. Depreciation wamepita tu hivi kando kando, they did not want to say. Therefore, to get depreciation, we are going to reconcile PP accounts. We are going for that PP. That is where we are going to get our depreciation. That is 1. 2, goodwill. We are going to reconcile goodwill account to help me get impairment. I think from there we can start presentation. Maybe small workings which will get us on the way. I really don't encourage people to concentrate much on workings because they waste a lot of time. So let's have working 1. You can start practicing that as early as now. In that page, make a line, presentation on the far left, the far right. Sorry, workings on the far right, presentation on the left. Yes. So working 1, let's reconcile property, plant, and equipment. Because they have not given us depreciation, so I must be very keen on that. So check additional information number 1, where the additional information started. At the beginning of the year, you work with the carrying amount, which is the net book value. The value of PP balance brought down. No. Do we really need PP? No. I need to do provision for depreciation first. That one will mess me big time. Let PP come next. So this one will be working 1 over 1. Provision for depreciation. Sorry. Provision for depreciation. I need to get depreciation first. Provision for depreciation. That's good. You're going to support. Provision for depreciation. So balance brought down. When you check additional information number 1, you will see provision for depreciation be 15,250. 15,250. I hope you can be able to capture that. Then go to the notes. Note 1, they say during the year, G Limited disposed of an item of equipment for cash of that. The equipment had cost 750 and had accumulated depreciation of 370. So less depreciation on disposal. So depreciation on disposal, they have said this was 370. You subtract that. Then note number 2, G acquired S. G acquired S. The property, plant, and equipment of S came with provisions for depreciation. So add S Limited. S Limited came with the depreciation worth 29. I hope you can see 29. Note 2, those items which were acquired. So you add, because this is acquisition of subsidiary. Therefore, depreciation should be this total. How much? If you adjust, let me pick something in the office. So just give me the answer there, just 1 minute. Give me the answer there. $17,780. Can you compare with the closing depreciation? Can you compare with the closing depreciation? So people are giving me 17,780. So that should be the total depreciation at the end of the year. If you check note 1, the examiner is saying balance carried down for depreciation is 19,500. So the increase in depreciation means we charged. There was charge of more depreciation during the year. So balancing figure is charge. Depreciation charge for the year. So D for the year. BF, balancing figure. How much is that increase? 1720. Thank you. 1720. Good. 1720. So already I have depreciation. Already I have depreciation. Then I need impairment. So impairment, I need to do goodwill account. But for now, I first of all want to reconcile the PP account. Whether to find a PP as early as now to malizane mapema. So working 1, 2, property, plant, and equipment. Property, plant, and equipment. You need to know the acquisition or disposal. Immaculate, why are you unable to hear me the way my voice? Just restart your device. I can see, I can see the waves, how it is fluctuating. It is on high, the highest end. So Immaculate, probably your device, you can restart. Ama wacha niulize randomly. Jenga, are you able to hear me properly? Patrick, Immaculate is saying the voice. Yeah, Mas is saying it is quite audible. So Emma, you can just restart your device, then it acquires out. So let's go to PP. Let's go to PP. PP, you will say balance brought down. We just want to check acquisitions and disposals. It will help us though later in investing. So balance brought down, you go for the carrying amount. You go for the carrying amount. So now, the carrying amount at the beginning was 14,750. Was 14,750. I hope you can see that. 14,750 PP at the beginning. Not one, just check, not one there, 14,750. Let's go to the additional information. We factor in everything. We factor in everything. So in note one, there during the year, G disposed an item of land for cash proceeds of 260, the equipment at 750, accumulated depreciation 370. So less disposal. Less disposal. So disposal, remember this is net book value. So disposal also you bring net book value, not cost. So you will take 750 minus 370. So that is that is the book value which you need to subtract. So 750 minus 370 is likely to be how much? 380. Sure. Yes, 380. 380. 380. 380. Then note number 2, we acquired a subsidiary. So add subsidiary. Subsidiary came with, the cost was 5, accumulated depreciation was 29. So we bring the book value. Always work with the net book value. That one will give you 21. That one will give you 21. So the disposal, this one you are supposed to subtract 380, not 38. 380. So that one you are supposed to subtract, but this one you add the subsidiary because the subsidiary was acquired. So you add it. Then note 3, NCI, no. Note 4, investment, no. Impairment, nothing. Nothing. There was no revaluation in the question. So it means this should be the total PP at the end of the year. Can you add for me this total? Add for me that total. People are getting 16. 16,470. Thank you. 16,470. So balance carried down. Compare. Carried down, you are seeing 23,500. So the increase in PP is acquisition. Why is 16 and not 23? It means they acquired. So acquisition, which is the balance in figure of how much? That is what they acquired. How much is that? It will affect our cash flow. Depreciation. You know, we are working with the net book value, so we're supposed to subtract depreciation. Sorry for that. Find the factor for depreciation, put it somewhere in within, less depreciation. I've forgotten about depreciation. Depreciation working 1 up to 2. Just fix it somewhere there. Depreciation, this one here. The 1720. It should reduce the value of the assets. 1720. So you can drop down 16,470 minus 1620. 1720. It will be how much? Sorry for that. And why do I always forget about depreciation every time? So 5310. Right? 16,470 minus 1720 is it? Hiyo si ni kidogo sana. 16 for 70, we reduce depreciation of 1720. It will go back to Nancy, 14,750 there. 14,750. Then it went up. It went up to 23,500. So the increase is how much? Now the increase is the acquisition. So help with that increase. The increase 87.50. 87.50. That is what we will take as cash outflow. Under investing. Alright. Same note one. Same note one. We sold an item of PPE. When you are selling PPE, you should be able to tell us whether you lost or you gained on sale. So the book value of the asset we disposal was 380, but we sold it for how much? Check note one, 260. It was sold for 260. So we lost. So down there, loss on disposal. Loss on disposal PPE, 380 minus 260. We lost 120. That is a loss to us. It will be very important ahead. So when you want to check whether you gained or you lost, you compare the book value, net book value, not cost. Net book value vis-a-vis the amount you received. So don't take the cost, you check the book value. Book value will be the cost minus the accumulated depreciation. Then you compare with what you have received. Then another working will want us to check. Goodwill will catch up with us. So I want us to check the goodwill component. When this subsidiary was acquired, how much was the goodwill? That one we need to check because the examiner never gave us. So goodwill, you will go for two computations. One, to determine goodwill on acquisition of that subsidiary by that time. Then two, you reconcile goodwill account to determine impairment loss. So let's start with goodwill computation. So that one, call it working two. Let's call it working two. So working two one is goodwill on acquisition of S Limited. So when we acquired S, how much was the goodwill? Our main aim, actually, apart from usually setting in the corner, so many, I don't know what was the big issue there. But mostly in the cash flow, goodwill normally has two workings. One, to determine goodwill which was there in that company. Then two, you reconcile goodwill to determine impairment loss. So there we go. Purchase consideration. Purchase consideration. There were two issues here which we need to be very keen. They acquired by giving out shares. Then there was cash which also they paid. So we need to be very keen at that stage. So let's check. They said note 2. We are in note 2. Additional information number 2. On 1st January 2022, G acquired 75% of the 100 million ordinary shares of shillings 10 each in S. The acquisition consideration comprised a share exchange on the basis of 2 shares in G for every 3 shares acquired in S. So issue of shares, they gave 2 for every 3. They gave 2 for every 3 in S. G Limited was also to pay 810 to S Limited on 1st January 2023. You see, the acquisition was on 1st January 2022, but they want to pay in future. Whatever they are paying in future is called deferred consideration. It is deferred. That one is coming later. The market value of ordinary shares on 1st January 2022 was shillings 30 and 20 for G and S. So for the issue of shares, they were giving 2 for every 3 acquired, but they acquired 75% of their 100 million ordinary shares. They were 100 million. So they acquired 75% of 100 million. Then of what they acquired, they were giving 2 shares for every 3. But the market value of the parent shares on that day was shillings 30. That is what the examiner said. If I try to comply, it is 75% of the 100. So they were giving 2 for every 3 acquired. You know, acquired is this one here, the 75 over 100. Then you determine the number of shares, then you multiply with the market price. Market price, we use the market price of the parent, the one which you acquired. How much will that be? Tell me how much. Tell me how much that will be. Someone is saying that you thought the market value is 20. No, 20 is in your subsidiary. You know, the person issuing shares, the parent. Parent is the one, you know, it's the one going for acquisition. So they are the ones giving out shares to acquire that company. So you value the shares using the market value of the acquirer. When you are acquiring my company, now we pay pesa, when I pay shares, you give me shares at the value your shares are credited. So you use the market price and be thorough on that. On any account, on any group accounting, you use Meshai level. So this is 1500. That is 1500. Then there was deferred consideration. There was deferred consideration. There is amounts they wanted to pay in future. So in future, they are saying they want to pay 810. So that 810, you must discount it to present value. So the cost of capital is 8%. Is 8%. Is 8%. So 1 plus R. 1 plus R raised to power negative n. So it will be 810. Sorry. It will be 810 million times cost of capital raised to power negative is 1 year, because the acquisition was 2022. They want to pay in 2023 after 1 year. So N is 1 year. You know how we normally do discounting. Or you can say 810. I don't know that it's normally the same. I forgot about these things. Divided by 1.08. 1 plus R. Does it give the same answer? When you do that, does it give the same answer? Hapo kwa finance, maybe bishana, nyinyi ndio mnaelewa zaidi. Will it give the same answer? You think I said yes? So if it is yes, how much? If you discount, what do you get? You can just take N, actually in a the same. For non-annuities, you just take N over 1 plus R equal. You will always get the same answer for non-annuities. Or 1 plus R is power negative n is the same. So whichever makes you happy. You are saying 750. So that is 750. $750 Then I saw minority. Minority, I saw them somewhere. I saw minority somewhere. They were saying in note number 3, they were saying the group's policy is to measure the non-controlling interest in subsidiaries at fair value at the date of the acquisition, or whichever. The market value of the subsidiary ordinary shares. The market value of the subsidiary's ordinary shares. So ile ulikuwa unasema. Market value of the ordinary shares are considered to be the representative of the fair value of shares held by non-controlling interest. So non-controlling interest, you come here and say fair value of NCI. They were having 25 because parent acquired 75. So minority, you give them 25 of their 100. But this time around, you multiply it by how much? 20. You multiply by 20 because minority are in the subsidiary. So they are saying their fair value is represented by the market value of the subsidiary's shares. So you take 25% of the number of shares and the market value of the subsidiary's shares. How much? Mwende na leo internet inakusumbua sana. What's not happening? Or you travel. So 500. Can you add? Internet inafanya kuhusha nje ndani out. What is not happening? Not usual. Nancy, 2750. Then you less net assets. Net assets acquired. Net assets acquired. Check. What they mentioned kweli? Yes, they mentioned. In that note too, those things which they gave us in note 2, those are the net assets. Even they said the fair value of assets and liabilities of S at the date of acquisition was as follows. So the total is how much, which you can see. How much is the total which you can see? How much is the total which you are able to see? 25, correct. So the total net assets is 25. Those PPE, which they acquired in that company, they are the net assets of the date of acquisition. Therefore, goodwill on acquisition is how much? That is 250. Remember, this subsidiary was acquired during. It means it was not there at the start. Therefore, if there is no impairment, opening goodwill plus this one which came during the year should give you the closing figure. That's why I told you must do two workings for goodwill. Roman 2, goodwill accounts. Goodwill accounts. You must do those two workings. So goodwill accounts. You check balance brought forward. And you check non-current assets. How much was goodwill at the start of the year? Go to non-current assets. You tell me how much you can be able to see. How much was the opening goodwill? $41.40, yes. Opening goodwill is $41.40. During the year, S Limited, S has are coming with a goodwill of 250. So this is 250. Meaning we are supposed to close with a goodwill of 4390. But the examiner is closing with how much? The closing goodwill, which you can see there, is 4200. They closed with 42. So the decrease in goodwill is impairment. So impairment loss is the balancing figure. How much? That's the impairment. Somebody is making noise, so allow me to mute everyone. So that is 190. That is 190. Thank you. So impairment is 190. Kick. There are some other small workings which can get us along the way, but now we can start. There is nothing which can bar us from starting the presentation. Unless someone has a question. Unless mtu ako na swali. I want to start the presentation. Hapo kwa presentation haina maneno mingi. Any question? Any question before I kick off presentation? It has started raining in CBD, so steam inaweza potea huku pia anytime. Sasa vitu siku hizi ni unpredictable. So it seems there is no question. Therefore, right there, they are calling themselves G group. So right there, G group, consolidated statement of cash flow. So G group, consolidated statement of cash flow for the year ended for the year ended 30th September 2022. Have one column is enough for us. You know what is like but presentation, no problem. So we start with operating activities. Operating activities. So operating activities kick off with profit before tax. Profit before tax. How much? How much is our profit before tax? 880. Sure, answer you sure. Nancy, unataka hiyo mark ya free unataka kupoteza? Mark ile 3440. Yes, is 3440. Nancy, kwa nini unataka kupoteza marks? So this is 3440. 880 is the income tax. I think that is much ime usifanye huko kwa mtihani hiyo mark ndio mark. One of the marks you cannot afford. Then you say adjustments. We can't afford to do that much. So adjustments, you bring depreciation. You bring depreciation. Depreciation, we work it out in working one. So check working one. 1720. You add. The sister of depreciation is impairment. So impairment, check working two. We got 190. Also, you add back. You add back that impairment. Then there was loss on disposal. Loss on disposal. Also working one. We got 120. Even that one you add back. You just add back. Then now, let's go to P&L. Between revenue up to profit before tax. Somebody has joined with Huawei and asking which setting is this. So into Huawei, the one who is asking which setting is this, please. Can you tell us who you are, because you are not even displaying your name? Then we will comfortably tell you which setting is this. Huawei, who are you? Huawei Y9 2019. Najua kuna watu wanaingia class na wasi wa hii class. So Huawei, who are you? Just identify yourself, then we'll tell you very fast. Ama nikutoe kwanza because so Faith, this is April 2023, question 5. April 2023, question 5. April 2023, question 5. So Faith, I hope you have understood. Nimejua ni which Faith. April 2023, question 5. So Faith, I hope that is okay. So what I want us to do, we come from revenue. Revenue up to profit before tax. We remove items within this space which are non-operations. So I want you to tell me which are these items which you are able to see and which are non-operations, kindly. Tell me which ones they are. Which ones are you seeing? The non-operations between that space. We want to do, I just want you to mention their names. The ones which you are able to see. Fair value gain, that is one. Another one. Fair value gain, then there is finance cost. Those two. Thank you very many. That is very good. So finance cost, finance cost, that is not an operating expense. We don't incur that on daily operations. The rest are okay. So add it back. It was subtracted. So finance cost was 280. So that one you add back. 280 you add back. Then fair value gain on short-term investments. Fair value gain on short-term investment, 170. That one should be subtracted. You need to subtract that one because it was added. So only those two. There is nothing else. So what you get is now the cash flow before working capital changes. So this is cash flow before working capital changes. How much? Can you adjust and tell me how much? 5580. So someone has 5580. Thank you. 5580. Bring the working capital. Bring the working capital. So working capital, we only check increase or decrease on inventory, receivables, and payables. So I want you to do for me, analyze for me inventory. Tell me inventory has increased or has decreased, and by this much. Check inventory, then you tell me increase or decrease by this much. I'll be very happy. So far, walete cash flow ama wasilete? Waiting for the answer. Inventory, according to Gashinge, inventory has increased by 420. Increased by 420. Mercy. One more person. One more person. Immaculate, increased by 420. Allow me to confirm. Allow me to confirm. Inventory at the start was 7660. We acquired a subsidiary. Please don't forget about the subsidiary. So we acquired a subsidiary which came with 820. So let me calculate this. So it is 7660 plus 820. Then it increased to 89. Perfect. 420. 420. So 420 is very much okay with us. 420 is very much okay with us. Thank you. So increase in inventory. Inventory is 89 minus 7660 plus subsidiary. Thou shalt not forget about subsidiary. Subsidiary is what is making this cash flow to be advanced cash flow. Ukiwacha hiyo mambo ya subsidiary being acquired or being disposed, wewe unafanya cash flow ya wale watu wadogo huko chini. So make sure you are anything chochote ufanyacho kwa cash flow, always bring subsidiary. That is what makes cash flow in this class to be advanced cash flow. That subsidiary component. So any moment you are forgetting about subsidiary, then you are doing a normal cash flow. So anything you are doing, thinking begins after you have factored the subsidiary. Take notes. So this is for 20. Of course, with less. Increase in stock means you are buying. Cash is going out. Let's go to receivables. Receivables, we started with 7010. They acquired 650. So I'm expecting 76. It went to 74. That's a decrease. Just tell me decrease of how much. So decrease in receivables. Decrease in receivables. 7420 minus 7010 plus 650. So decrease is how much? 240. So people say 240, and that is a plus. 40 is a plus. Correct. Let's go to payables. Payables for current liabilities. 8750 plus 1200, hiyo inafika karibu 10. That is also a decrease. So decrease in payables, decrease in payables, decrease in payables. So payables. The start was 8750, so it is 9790 minus 8750 plus subsidiary came with 1200. So a decrease of how much? A decrease of how much? A decrease of how much? $160. So 160 we subtract. Decrease in payables means kazi yako ni kulipa suppliers. So pesa inaenda. Kwa nini madeni za nje zimepungua? So give us cash generated from operations, tulete tax na interest, tumemaliza hiyo. So cash flow, no cash generated from operations. Ngapi? $52.40. $52.40. I hope everyone gets that. $52.40. $52.40. Tax paid, interest paid. Interest paid. What we get, we call it A. Then we are done with that. So write those two. We can do a working for those two. Yeah. So people are ready. Let's have working number 3. Let's have working 3. Tax paid. Something is telling me I try you with that. And yes, I'm trying you. Can you do your calculations? You can even refer to what we did. I have no problem. Refer to how we calculated tax in the other question. Try to bring it here. Then you see whether you can get the tax paid. Please try it out. Try it out. You just give me a figure once you have it. Then I'll confirm. Somebody to give me the tax paid. Haya. So Faith tax paid 655. So Faith amepeana yake. Mmedifa na Jenga. Jenga is giving 545. 655, 545. Unaka small variation there. 545. Gashingi. For 545. Mercy. 545. Any one more? I don't have the answer, so Joy 525 and Lisa 545. It seems people are giving 545 the highest. So in case maybe you missed it somewhere, let's do a working just to confirm. Let's just do a working to confirm, then it will be okay. So because I don't have the answer, let's just go to workings. I can't waste time doing that. So let's call it working 3. So working 3, taxation. Taxation. So taxation, balance brought down. Combine both deferred and current. Combine both deferred and current. So deferred tax 450. Current 580. How much are you saying? Then you will tell me when you are because you have different figures. So lazima tupate wenye wamekosea. You will tell me what was the issue, then I can clarify. 1030, Joy. So this is 1030. For the year, P&L. P&L for the year, we were charged income tax of 880. Subsidiary came with the tax worth, sasa hapo labda hata mkikosea sitakulaumu sana. When you make a subsidiary, it can bring some problems. It can bring some problems if you're not very keen on it. So you see, this was a liability at the beginning. During the year, we had another liability to pay, but the subsidiary came with the current tax 20 and deferred tax 110. So this is 130, but the 130, all of them were credit tax. Because 20 they said was refundable. This one is deferred tax assets. So the 130 should be utilized to reduce your liability. I think that is what maybe has confused some people. Because the current tax 20 is refundable, this is an asset. So you cannot add them. You cannot add them to liabilities. You could have only added if they were also liabilities. So I hope you have understood. So I'm using the refunds to offset the liabilities. So how much will this be? How much would that be? So the balance should be our obligation at the end of the year. How much? $1,780. Closing as per Mr. Examiner. Deferred 620. Current 745. What is 620 plus 745? That is 1365. So the decrease is what they paid. So they paid how much? How much did they pay? How much did they pay? They paid 415. So I don't even want to ask you why you went wrong. I think that was quite sensitive. When it's an asset or refund, utilize the refund to decrease the liability. So you cannot add it together with the liabilities. So go to the presentation. Go to the presentation, tax paid 415, cash outflow. You subtract. Another working outside there. Okay. That is a very sensitive working also. Interest paid. So this is working 3.1, working 3.2. Interest paid. Interest paid. So tax is working 3. Interest is also working 3. After kama you solely a balance, there is something on interest which may I think should be there. So interest accrued, check current liabilities, balance brought down, there was no interest. There is no accrued interest under liabilities. Subsidiary never came with any interest out. P&L, how much were we charging the P&L as finance cost? So never forget about the P&L at any point. How much were we charged in the profit account for the year as finance costs? We were charged 280. Let's check. Finance cost, yes, we were charged 280. So at the end of the year, we are talking of 280. Skip one line. Balance carried down. So if balance carried down, you have to be very smart. Very smart. You know what happened in working two? These people, when they were acquiring this subsidiary, they deferred. There was deferred consideration. There was a deferred consideration of 750 to be paid next year. Any moment you defer and there is cost of capital, there is always interest on the, should I call it interest on deferral or deferment, whichever. So there is the interest, there is finance cost on whatever you are deferring. Therefore, you take it as the closing balance because that one will be paid next year. So you'll come here and say, balance carried down will be 8% times 750, but you know 8% was per annum. This subsidiary was acquired on 1st January. We are closing in September. So the subsidiary is only 9 months old. So you take this one times 9/12. You can write here deferred consideration. That is the deferred consideration. That is the closing. You are going to be at the end of the year. So I'm taking 8% of 750, but you see the figure you're going to get is per year because 8% was per annum. But subsidiary was acquired in January and we are closing in September. So the interest you should only calculate for 9 months. How much is that? How much is that? 45. So it means our closing interest is 45 instead of 280. So the decrease is what we paid. Paid bigger, the balance is bigger. How much the decrease? The decrease is how much? The decrease in interest, 235. Thank you. 235. So give me the value of A. 5240 minus those two. What do you get for cash flow from operation? 4590. 4590. We are done with operations. Unless you have a question on anything. Unless someone has a concern or something. Umeandika lakini haijakufurahisha. If there is nothing like that, we go to investing. Let's go to investing activities. Investing hata sioni tupika. Investing hainanga maneno mingi. So investing activities. So for investing, let's go to non-current assets. Let us go to non-current assets in the balance sheet. Kindly, let's meet in the non-current assets. So good. So in the non-current assets, I've seen only two items. I've seen PP and goodwill. So PP, you give us two items, I told you. So cash received on disposal of PP, cash paid to acquire PPE. Those two. So in regards to PPE, you bring those two. So check working one, two. In working one, there was disposal. How much did we receive? Check note one. Yeah, I've already been told they are 260. Yeah, we received 260. That is okay. We received 260. Then cash paid to acquire, we did a reconciliation in working one, and we got 8750. That is cash outflow. So make it cash outflow. We had already done that working. Then something which normally comes there but is not there today is net cash paid to acquire subsidiary. Net cash paid to acquire subsidiary. There is nothing because the acquisition of subsidiary, one, they gave shares, two, they refund. So the cash payment is there, yes, but it will be paid in the future, the 750. So there is nothing to be considered right now. Yes, they will pay, but in future. So right now there is no cash, which call it B. Once you are done with the non-current assets, you only check the subsidiary, what you paid to acquire or what you received on disposal of subsidiary. So investing, I had a lot of stories. How much is that? To the negative figure. Thank you. That is, thank you, I'm the repair. How much? Why have you taken long? 84.90, but negative. So 84.90 negative. That is cash flow from investing activities. Then we go to financing. Financing activities. Financing, tuteremke hapo chini kwa equity. Financing, let's start with equity, then we go to loans. So equity, at the start of the year, check beginning of the year. Beginning of the year, the parent company, will I really confuse you? Maybe. What are the fund you're working? So have a working so that I come out clear. Have a small working outside there for ordinary share capital. So call it ordinary share capital. I'll show you what happens. Ordinary share capital. So ordinary share capital, balance brought down. Bring both ordinary and premium. Those are one family. Familia moja, ordinary and premium. So ordinary, 15,000 plus share premium, 3,000. So that is 18. That is 18. Then during the year, check here. Parents issued some shares, issue of shares. Parents gave shares worth 1,500. So this one in two. They gave shares worth 1,500 to acquire that subsidiary. So to acquire S Limited, parent issued shares worth 1,500. Meaning at the end of the year, we need to close with 19,500. We need to close with shares worth 19,500. Close of the year, check the two, 20 plus 45. 20 plus 45. They close with 24,500. So the increase means these people gave shares, and they're not giving for stones, they're giving for cash. So cash on issue, balancing figure. They gave new shares for how much? The increase from 19,500 to 24. They gave out new shares. So we have to factor for that. $5,000. So cash on issue of shares. You don't need to switch working. 5,000. So have it there. Go to the next. Go to the next. Next item under equity, ordinary bond, share premium bond, retained earnings. Retained earnings, I told you, sorry. Retained earnings, you can, we normally utilize it to determine dividends. Dividends paid to the parent. You're working with Sivan, you can do it here. So write this way, dividends, holding company. Dividends to the holding company. It's something you can do there without wasting time with a lot of unnecessary workings. You can, I know, you can, very well. So, what was your retained earnings at the start of the year? The start of the year, I'm seeing retained earnings of 4340. So 4340 plus profit for the year attributable to the group owners was how much? I want you to tell me. Mkiona hiyo, then we are done with retained earnings. How much did parent get during the year? This was there at the start. During the year, you go to P&L. How much was attributable to the members of the group? Members of the group are the parent. How much you can capture with your own eyes? Nancy can see 2040. Kashigi 2040, that is true. So parent got 2040. So it means the parent, members of the parent company should claim 4340 plus 2040. But examiner is telling them that is not what you are claiming. You are claiming retained earnings at the end. Check the closing under equity, 60-10. They closed with 60-10 instead of almost 60-something. So the decrease is what they were paying. That's why I'm saying there's no need to waste time with a lot of workings. How much is that? How much? How much? 370. So these people were paid 370. So you bring dividends, NCI. NCI wakisikia parent wamekaa huko kwa ofisi kubwa. Asubuhi wapi washakuja. Tell us what is not happening. So NCI, hiyo account yao wacha tufanye. Let's do it. Let's do the account for minority. Though it is not hard. Hata naifanya hapo nikitaka. So in opening plus during the year plus subsidiary, then you compare. But wacha tufanye hiyo working because even my space is very congested. So our working, call it NCI. Call it NCI. So NCI, balance brought down, P&L, subsidiary, then we compare with current down. The difference will be dividends. How about as simple as that? So brought down NCI under equity, non-controlling interest, you can see 1080 somewhere. Under equity, P&L attributable to noisemakers, you can see 2020. Subsidiary, check working 2-1. Working 2-1, you'll be able to see 500. The fair value of minority. Just check working 2-1. You see the fair value of minority was 500 in that subsidiary which came. So how much is the total? How much is the total? How much is the total? 21. Then we closed, check the closing figure. We closed with 1840. So the decrease in NCI is dividends. So dividends is how much? The decrease. The decrease here is dividends. Of how much? 260. We are done with equity. Check if there is a loan. Then we are done with the financing. Check whether there is a loan. Check whether there is a loan. Yes, loan is there. Loan at the beginning was 3. At the end, loan is 26. But check whether subsidiary came with a loan so that we don't forget about it. Subsidiary, hakuna, they never came with any loan. So it's a direct comparison. From 3 to 2, what narration can I give it? Somebody? What narration can I give that loan? Opening loan was 3. At the end of the year, loan is how much? Loan is 26. So what narration do we give that? Loan payment. Yes. So you call it loan repayment. So loan repayment is 3 minus 26. They paid 400. That is cash outflow. Correct. Hata ukiandika loan payment, hata ukiandika tu loan peke yake, kitu examiner anataka kuona with that negative figure. So there is nothing under financing. We are done. So can you add for me? Call it C. Call it C. Call it C. How much is the financing? Nancy, 3970. 3970, that I hope that is positive. So net cash flow, A plus B plus C. Can you combine the three? Then you give me the net position, kindly. Net three, A plus B plus C. Tell me the net position. Remember, B is negative. People are getting positive. I hope that is a positive figure. Positive 70. So have there positive 70. So this is 70 positive. And sema ukweli anakuja cash and cash equivalents. Cash and cash equivalents brought down, then cash and cash equivalents carried down. Like that. All right, so let's work out cash and cash equivalents. Is the last working? Cash and cash equivalents. Cash and cash equivalents, 2022, 2021. Hiyo space itatosha kweli, tutaona. 2022, 2021. So there was cash at bank. Cash at bank. Cash at bank. Give me the two figures. Cash at bank, 310 to 40. 310 to 40. There was no bank overdraft, but there is investment at fair value through profit or loss. I told you, when investment appears under current assets, that is cash equivalent. So investment at fair value. Investment at fair value, 2570, then 2400. 2570, then 2400. What you should not forget, check P&L. Check P&L. There was something we need to adjust. There is something we need to adjust. There is something we need to adjust. Fair value gain. Fair value gain on short-term investments, 170. So fair value gain, of course, you can't add it at the end. P&L is during the year. So you add it on the opening. You say, I've opened with this, I gained this, then you compare with those. So that fair value gain should be here. But I know some students can take that fair value gain up whatever investment income. So that income example is not wrong, but it should be part of this one here. So can you give me the two answers? Those are our cash and cash equivalents. Some students will take that 170 to invest it. Then they argue that it was You know, this thing is not long-term investment. This thing is short-term. So it goes to cash equivalent. So how much? Beginning and closing. Let's start with 2021. Okay, so give me those two answers with a comma, then I'll know. $26.40. So this is $26.40. Then the end you are giving me $28.80. This is quarter 640. We are add 8, 170, 28.10. Check Nancy. This is 28.10. I will direct 170, 28.10. So if you add 28.10, do you get the 28.80? You have to reconcile. Do you get the 28.20? Do you have another one? Yes, it should. It should. Because 70 plus that, 28.80. Yeah. So it is in order. It has reconciled with your closing figure there. Will you please explain again on the last part of cash and cash equivalent? What exactly do you want to know? The exact point. Tell me the exact point, then coming there, full force. Why did the investment and why add the investment and fair value? Yes, you know, short-term investment. What is cash and cash equivalent? Cash and cash equivalent is cash in hand, cash at the bank, and any short-term investment. Any investment appearing under current asset is a cash equivalent. Those which are highly liquid, mostly shares can be disposed of anytime. So any investment which is short-term is a cash equivalent. You know, cash equivalent means something which can be converted into cash. So even examiner told you in note number 4, investment at fair value through profit or loss consists of highly marketable and risk-free securities by G Limited. So they are highly liquid assets which can be converted into cash. So we normally treat them as cash equivalent. That notwithstanding, any question which is coming in the future, any moment an ideally investment should be long-term. So any moment examiner captures investment and current assets, then that is cash equivalent. It goes to reconciliation down there. Then this 170, they said it was fair value gain on those investment. So it should be adjusted against the investment. So Rashid, I hope you are hata kama hujaelewa 100%, I hope you are somewhere. Good. Ndeka hapo chini. Repeat using direct method. Repeat using direct method. So direct method, we are only working the operating peke yake. Investing and financing are the same. Investing and financing are the same. Those two are the same. So we only work the part of operating activities. So right there, repeat using direct method. So direct method, one, we want to check cash received from debtors. So trade receivables. Trade receivables. You reconcile trade receivables to determine how much you received from the debtors. So let's have that one as a working. Let's have that one as a working. So trade receivables, balance brought down. Balance brought down. Balance brought down. Receivables balance at the beginning was 7010. You add revenue. Revenue assumed credit sales. You assume all of it was on credit. So you bring there 18,590. You add subsidiary. Subsidiary was acquired. If at all the subsidiary was disposed, you subtract. So subsidiary came with trade receivables worth 650. So this one should be the total value of receivables. But examiner said balance carried down of receivables is 74.20. So the decrease will be the cash received, the balancing figure, cash received, BF, the balancing figure. How much? I just want the cash received. Add them, compare the two. We are almost done. Meanwhile, Joy, the class rep, kuna kapost nataka uniangalilie, then you repost the workflow. There is workflow on how tulikuwa tumepanga how we want to cover the ile unaijua what are written the dates and how we are intend to cover the syllabus. So you will repost, nikimaliza we check, we verify where we are. Meanwhile, how much is this? 18,830, Nancy, 18,830. That decrease is what we received. You know, direct, it only checks the cash received and cash paid. Only, it doesn't go to a lot of stories. You come here and say, cash paid to employees. Cash paid to employees. Cash paid to employees. Cash paid to employees. So for employees, you come here and say distribution cost, administrative, admin expenses. Sometimes we'll just say operating expenses. You pick that lump sum figure. But here they separated. Distribution was 1330. This other one was 2460. So this one was coming to 3790. That is the total. You know, admin and distribution. When I got distributions in the salesman, admin what was staff. So when you want to know what you pay the employees, you add these two. Then you less non-cash expenses. Non-cash expenses, let me let all of them. Depreciation, though I know depreciation was taken to cost of sales, but there's no need for wasting time, just subtract it here. At the end of the day, this one and cost of sales will be combined. So depreciation was 1720. You remove impairment. Why am I subtracting depreciation and impairment? You cannot see them in the P&L. Any expense you cannot see in the P&L means it was grouped inside here. Impairment was 190. Loss on disposal, we can't see it. Loss on disposal, 120. These are the only expenses which we are not capable. We are not capable of seeing them in the P&L. These three. The rest we can see. Finance cost we can see. Fair value gain we can also be able to see. So this is the correct figure of cash paid. How much? How much? How much? $1,760. So keep that 1760 safe for me. I want us to determine purchases, credit purchases. So credit purchases, watu wanafanya tax wanaelewa hii sana. Nasemanga ni complete records. So credit purchases, in-depth investigation. So purchases use this formula. Cost of sales is equal to opening stock plus purchases minus closing stock. So from there, we make P the subject. So P will be cost of sales plus minus opening stock plus closing stock. Yes. When you make P the subject of the formula, when you make P the subject of the formula, it will be like that. So you pia watakupea, they will not. Watakunyima in all the questions. So you follow this route. You know, there are some questions here, I can even pinpoint them for you after this, where you are told to use direct method. So ukiblog akili ati mimi na direct atupatani, mimi naendaga in direct routes. You have to master how you go about both the methods. So P will be cost of sales, 11 to 50, opening stock. So opening inventory, check inventory in the balance sheet and the current assets. So minus inventory opening was 1760 plus subsidiary. Subsidiary came with inventory worth 820. So musi kose board max. I know what I'm saying because tunachukua opening plus. Then you add the closing stock. The closing stock is 8,900. So please, to obey board max properly, first of all, work this bracket. So it's 1120 minus the entire bracket. You say minus, tutakosea. So work the brackets, then is when you subtract. Jacinta? And also check note one. Note one, when kuna issue. Note one was PP. Note two, I don't see anything. Note one, Gani, Jacinta? Note one sentence. Any gain or loss on disposal, depreciation is included the cost of sales. Is that what you mean, or which one? The loss or what cost of sales? Is that what you're saying? Just say yes, then I clarify. Yes, okay. So that in a waste of time. Because, and I explained, they have said depreciation loss what to go to cost of sales. I will subtract them here about administrative and the rest. Because at the end of the day, what you get here is going to be added before you present cash flow. So there is no problem if you admin distribution the assistance. Ukileta hapa history mingi itakusumbua. I know. From the experience I know, ukileta hizo hapa itakusumbua. But at the end of the day, we don't need this working. It is easier if you adjust them here. Then wachana cost of sales then you are going to combine what you get and this. So inakuwa familia moja. Mercy is getting 11,670. A confirmation. I fear mtu akikosea about mass hapo. 11,670 confirm. So 11,670. That is P. Now the final stage is to prepare trade payables. Trade payables. So that we can get what we pay the suppliers. So that we can determine the cash we paid to suppliers. We can determine the cash paid to suppliers. So suppliers payables brought down So check the trade payables brought down. Trade payables brought down, you will see 8750. 8750. $87.50. Then subsidiary. Subsidiary came with payables worth 1200. Then you add credit purchases. Credit purchases. We have assumed all purchases are of credit. 11,670. And then the closing, we have been told that closing carried down by our able Mr. Examiner is payables is 9790. So the balancing figure is the cash paid. BF, the balancing figure. So tell me how much is the balancing? Thank you. 11,830. That is what they pay. Bus. So let's go to presentation. Presentation should now take us less than 5 minutes. For presentation, you say G group, consolidated statement of cash flows for the year ended. The year ended when? 30th September 2022. One column, shillings in millions. Operating activities. Mambo. So I believe you are good to go. So cash received from customers. I remember we received 18,830. Check the working we did, working one on direct method. We got 18,830, I hope so. Then cash paid. Cash paid to employees and suppliers. Employees were paid this one, 1760. Suppliers, tumepata hapo 11,830. How much is the total? This plus this will be how much? How much, students? Goes to? $13,590. So cash generated from operations. Cash generated from operations. Cash generated from operations. How much? $52.40. Tax paid and interest paid, those ones remains the same. Whichever approach you take, those ones remains the same. Those ones are the same. So tax paid to the Matagam, where are they? Tax paid, we got 415 from where we worked it. Interest, we got 235. So this should be A. And it will be the same with the other one we got. How much? And it is in agreement. How much? And it is in agreement with what we got the other side. Joe, you should have shared with me that stuff. I don't know whether you have traced it back. $49.90. Is that what we got at the other end? 45.90. Is that the other side? Confirmation check. Yes. So jipange vizuri na hii direct method. Wakidictate, bas kila mtu ako hapo. So you don't struggle. To avoid to comply with time, I have this suggestion. I can share with you. I have so many videos for last week, those other settings for cash flows in that past paper. I can share one with the solution. Mr. Keda, staki msumbuke kusoma vitu mingi. Just practice these two thoroughly. Then you ongeze moja video yake na solution. Then you're just good to go. You are ready to face any cash flow in exam. So I want to check our workflow, where we are. We do self-assessment. You have to do how we are moving on. Joy, did you manage to get that stuff in the group? We shared it a long time ago. Or whoever has gotten it, can you share? There is how we had planned coverage, so it's good to check where we are. Now umetuma kweli? Oh yeah, it has been shared. So please go to the group, we check where we are. Yeah, so from where we were, we have covered the group. So we have covered group, your 10 mpaka cash flow. Today is 12, and we are at cash flow there. And also the same 12, Leo, we were supposed to be doing insurance. You know why we are not up to that stage? You know why? The reason is because of Saturday, we did not have a class. We missed one class. So, but who is God? God has given us holiday to plant trees. So one of the trees we will be planting is that insurance. We had agreed to meet. So insurance, I think if we observe that, we are good to go. We are very much good to go. So I request we meet tomorrow. I have section 3 from 7 to 9. I can meet you from 10. Insurance also needs like 3 hours. So 10 to 1 tomorrow. Hiyo tusipoenda hivyo unaona tu venye hapo kuko. We have to finish by 30th. You know, watch those days you revise. So just understand. Kesho muamke mapema mpande miti. Even me, I will already have the 6. Tomorrow I will wake up at 5:30. Mpande miti mpaka 6. Nichomoke nikuje kwa class. So kujipanga tu. So nyinyi mnapanda mpaka 9. Then we meet at 10, 1. Then from 1 you can revise on your own. Then kama kuna mwalimu atakuja evening class. So thank you so much for your time. Let's meet tomorrow, God willing, and keep reading. So I will share with you one video with the solution. One video with solution to supplement whatever we have done. Thank you. Have a good night. Let's meet tomorrow. Allow me to compress this video.